Daniel, you're very welcome to another episode of Kickoff Sessions. Before we start recording, I said I was a big fan of your work, mainly because I'm really so interested in like the psychology of money, psychology of wealth, how people approach different kind of approaches towards, generating wealth, and really the differences for so many years. I think it's really came from a youth of myself, kind of being interested in like saving, looking at different ways to do things like this from a very early age. And I think as I've got older, I've seen the importance of it. And things like your books have been very, very instrumental in baking in the logical and practical sense towards investing and managing money, really.
Yeah, thank you very much. It's great to be here, and it's incredible to see someone as young as you thinking about these things. So that's good for you and your listeners for getting an early jump on thinking about the psychology of wealth. It's a huge feather in your cap.
And I think as well, it's becoming more and more important. And I actually recorded recently another guy was talking about like financial literacy as a whole becoming so important because like easy access to markets, commission-free trading, all this stuff is dangerous and it's also a benefit, so there's two sides to this coin always. And we want to do things the correct way, be able to look at money from the correct perspective and not just the blowing the accounts approach, so I'm very interested in it. My audience are very interested in the process of trading, wealth management and trying to do things, but they may not even know these things, but they've been always trying to, learn, I suppose, because that's what our generation is trying to learn these different things.
Yeah. What's been neat about the last year and a half plus is that we are at this crossroads, like you suggest. Technology is making it easier than ever before to invest. Fees are coming down for the last 20, 25 years. Fees have been coming down across the fund industry about 10% year over year. So very rapidly declining fees, easy access. In many respects, there's never been a better time to be an investor. Mm-hmm. We know that the sort of mania, if you will, of the last 18 months, it's cut both ways, like you suggest. Like on the one hand, more young people than ever are getting involved in the markets. A more diverse slice of the population is getting involved in the markets than has typically been the case. More Black and brown people are getting involved in markets. And yet, we also see a lot of misbehavior, right? We see a lot of highly risky, highly speculative trading. So we are at this moment in time where young people and people who haven't traditionally been as involved in capital markets are getting in the game, which is nothing but good news, but they need to do it in a smart way, which is where a podcast like yours and hopefully books like mine come in. It's like, good, you're here. Like, we're glad you're here. Now let's do it the right way.
Exactly. It's like you've opened the doors towards all this opportunity, but if it's not managed correctly, you're going to end up burned, you're going to end up losing a lot of money, and then you're going to be disgruntled from the whole process. But I think what's really cool is like you go back to like the origins of like why people are interested in money. Like why is it that that me or you are always trying to pursue, generating wealth or whatnot? And from your own perspective, why do you kind of see that is? Why do you see this kind of move towards retail investing? And why has it been more easier for people like me, 24, 25 years old, to really want to get more engaged in markets versus going out and spending that discretionary money elsewhere?
Yeah, so we'll get deep from the outset in terms of why are people attracted to money? What any kind of living organism, right? Any kind of living thing has a couple of basic sort of primal goals. It wants to survive, it wants to live, and it wants to pass on its genes. Well, money helps you do both of those things, right? I mean, money helps you, of course, affords you all the comforts of life. It keeps a roof over your head. It keeps you, fed and able to go to the doctor and afford to live in a safe place. But also, in terms of passing on our genes, right? Like this is a real thing in society. Like, right, we are valued, we are esteemed higher or lower depending on sort of the capital that we've amassed for better or worse. So, I mean, money is at the root of everything we do, and it's a very primal need we have for it. In my book, The Behavioral Investor, I cite some studies where they looked at the electrical activation of a brain, right? So they have someone hooked up to a machine that measures their brain activity, and then they show them different prompts. So it would be things like, scary prompts, like, sad pictures of death, something scary. Then they'd show them, stuff that would arouse, more sort of lovey or even in some cases erotic sort of material. And then they show them pictures of wealth and money. More than sex, more than religion, more than politics, money excites people's brains, because in some ways, money encapsulates all of that, right? Power, wealth, sex, longevity, control, success, happiness. Like, it's all wrapped up in our idea of money, again, with mixed results. And so money is something that we care super deeply about. But because that's the case, it's also easy for us to get sort of overly emotional about it and make misguided decisions about it, because there's such a thing as caring too much, right? You can care so much that you kind of lose your head, I guess.
Of course. And if you think about it, how much it impacts our day-to-day activities. So like our financial decisions really influence whatever we do, whether that's eating at home, whether it's taking a lunch to work or whatever, which is quite interesting because people think that they're going to work or people think that they're going to their university, but it can often be based around these financial decisions. So it's kind of like, if I was in a more comfortable position, I can afford to take the bus versus cycle. And that's where it gets wrapped up in this kind of debate continuously. And then it's the pursuit of actually generating more wealth, because at that point, then you can do alternative options.
Well, it's a great insight you had. For me, sort of most fundamentally in my own life, I save money and invest money because for me, it's about freedom. It's about, of course, any American loves to talk about freedom. We're kind of big on that here. Again, with mixed results in a pandemic. But for me, it's about freedom, right? Like you can take the bus or you can drive the Ferrari, right? And everything in between. But this is something I talked to my wife about last night. I said, I hope that we can help our kids out a little bit as they're sort of entering the workforce, because I want them to have the full scope of career options available to them, right? Like if they want to do something that doesn't pay well, if they want to be a nature photographer, or, a school teacher, or a million things that don't pay extremely well, but that are worthwhile, that are pro-social, that are good for society. I want to be able to give them sort of those degrees of freedom. So I think that's the other reason why people can sometimes pursue money so breathlessly, is because it really does open up your options, right? I mean, it really does allow you to make more choices when you have more money.
And it can also kind of hindrance you as well, because like I actually spoke on my last podcast with a guy about young professionals, especially me, came out of college looking for the best graduate role salary. And now again, it's marginal, the difference, if you really break it down back in the day, but you're often then being kind of like tied to something for several years, because as you said there, I was picking something that may seem the best financially, but to be honest, it wasn't the best suited for me, and that's where you get wrapped up in that kind of debate. So it's like, do you essentially front load it, try to save much more money, give yourself the nest egg, so then maybe then you can take this and decide what you want to do. Because for young guys and girls like me, it's very difficult to be able to plan those mid-20s, because a big thing is the perception. You do want a bit of money so that you'll be able to go hang out with your friends and go traveling and whatnot. But if you don't give yourself that opportunity of getting a good career, good job, it's like it's two different sides and they're always going back and forth,
Well, it's a great point. We did research recently that hasn't made it out yet, but I'll tell you one of the things that we found. In North America, money is the number one cause of divorce. So you got half of the people that live in the U.S. and Canada get divorced, and the reason that they get divorced more often than not is because they're fighting about money, right? Money's in short supply. They're fighting about money. They don't agree on money. And so what we said is like, look, if we could help people understand their money preferences and their ideas about money better, maybe we could, at some of these points of conflict, we could give them some skills for having this conversation around money. So we basically looked for, what do people fight about when they fight about money? And the number one thing is the money best used to enjoy today or to secure tomorrow, right? So there's this continuum. Do we do we enjoy the moment? Do we live in the moment and sort of live it up? Or do we save that money so we have more optionality down the road? And of course, the answer is both, right? Like both are important, but finding that balance in a measured way is just, there's no easy answers, and the answer is a little of both. But what the specific mix looks like for you or your listeners is going to vary. But I do think that's an interesting continuum to kind of think about.
And it's also personality driven, and especially when you're with like your loved one and whatnot, because often people have different personalities. They've clashing or, quite similar. And if when it comes down to something like money, it's funny because it's often like, a taboo topic, whereas like it should be more discussed better educated. And then you get to a stage then whereby you have open discussions. And even I know that myself, my own girlfriend, you're trying to get to those stages whereby you have these open communication, But I think what's interesting, and even in that kind of study, like the evolution of it. So when you're younger, you're really scrapping for everything. You're in university, you remember when you're in university and you're eating rice and beans all the time. And then you get out and you're in college, you're out of college, you're trying to earn a bit of money. And then after a while, you do have some kind of discretionary money saved up, but it's about then at what point do you decide to either save for tomorrow or spend for today with that? And I think that's where we get into kind of a nice kind of element of behind your book, Behavioral Investor, about what do you do with that cash and how do you proportion it and how do you think about it more so than anything?
Yeah, I'd add one more thing to that conversation. There's something called the hedonic treadmill, right? So think about the two parts of that word, right? So hedonism is like the pursuit of pleasure, and then think about a treadmill that's sort of always moving but never going forward. Our pursuit of pleasure is like that. I was married. I was married 15 years ago. And so, I was 26 when I got married. I'm 41 now. So when my wife and I were married, we're eating beans and rice, right? When we're 26 and we're married and we have no money, now we're, eating steak and fish every night. You can't go backwards, because whatever you're used to at the time becomes your new normal, right? If you live up to an elevated standard, it's easy to raise your standards, right? Everyone wants to drive the nicer car, to eat the better food, to have the nicer house. It's almost impossible psychologically to go backwards. Like if some sort of financial calamity necessitated that my wife and I went back to eating like we were eating when we were 26, it'd be depressing. Like it'd be very hard. So people need to understand that when they're making these decisions about, do I elevate this lifestyle? Do I begin to live large at a young age? Pace yourself a bit because it can become very, very difficult, to go backwards.
That's an awesome point, because my generation is all around lifestyle inflation. And that's one thing that I have consistently tried to avoid. So like, you'll see me wearing the same 4 t-shirts continuously. You'll see me just doing the usual stuff, looking for the best friend. Now, I do live like a nice lifestyle. I get, I have like nice things, but I don't go materialistic. And I call it the Balenciaga effect. I don't know if you're familiar with the brand, but basically it's shoes that are €700, t-shirts that are €700, And the thing with my generation, and including me at times, is that as we earn more, we just spend more, So from, a psychological perspective, like, how do you think that's kind of been framed? Maybe it's more media driven, possibly. And like, what can we do to kind of combat it, really, to be honest?
There's a great program. There's a great program here in the States called Save More Tomorrow, that was developed by a behavioral economist who recently won a Nobel Prize, Richard Thaler, who won a Nobel Prize for his work. So what he has people do is pre-commit to two things, right? So pre-commit to automating their savings, like we could talk about that. That's a whole behavioral psychological piece there. But so pre-commit to automating your savings. And as you get raises, you save a larger and larger percentage, right? So let's say you're saving 10%, you get a meaningful raise. Now you're saving whatever, 15%, 12%. And you just do that over time. So your lifestyle gets better, but you're never sort of getting on that hedonic treadmill that I talked about, where your pay keeps going up and your lifestyle rises accordingly, right? You get the cheap shoes when you have the analyst job straight out of college. Then you get the managing director position and you start getting the Balenciaga shoes, and you never have any more disposable income than when you started. Money's very relative, right? Like I remember from getting my first job offer out of college. I finished grad school, I got a job, and I remember calling my sister and going, like, I made it, like I'm done, like, I'm set for life. If I can just make this, for the rest of my life, like I'm set. Now I look at that and I jump out a window. Like if I made that little money now, I'd be very upset and I couldn't live on it, because I had kids. That's one thing, right? But my lifestyle got elevated too. So you have to be careful and just make sure you're living in a smart way and don't engage in that lifestyle creep before it's absolutely necessary. The last thing I would say about that is, I write about in the book, The Behavioral Investor, the happiness that anticipation brings. The way that our brains are wired, it's almost like the anticipation. It's not almost, it is that the anticipation of a thing is more powerful than the thing itself, right? So we'll stick with the Balenciaga shoes, right? So you say, you know what, I can't afford these now, but I'm going to save and save, and I'm going to get these cool shoes one day. The process of saving and monitoring that saving and all of that for those shoes is so much more psychologically beneficial than actually getting the shoes themselves. It's kind of a yawn when we get the thing itself. So don't flood yourself with so much excess and so much high living at an early age that you have nowhere to go, because life gets more expensive, life gets more complicated, and you want to make sure that you have room to run, sort of.
Mm-hmm. And that accumulation is actually part of like the benefit of like saving and whatnot, and people actually get an enjoyment from it. Like, I don't want to use the word addictive, but it actually is like, I suppose the word is kind of addictive, but it's kind of more like it's thrilling, so that you can see yourself like doing something that's good, that it's thinking about the future. And then when you drop it on the Balenciaga shoes, it's almost as if like you've just wasted it to a degree. Now, again, you'll be able to use that asset, but it's interesting because like you mentioned there with the analyst role, it's very common to see like someone on 35K, living a cheap lifestyle, someone that's on 45K is now driving a leased car that's worth 45K, and that's like the matching of it. So with the excess amount of money, people always say to move into, investing and think of things as like long-term investing, passive investing, whatnot. And I think what's great is that there is information online. That's great. It's really helpful in saying that, you should be doing this dollar cost average for the rest of your life. Here's the chart that tells you make money. But the reality is things are a lot different in practical sense. Same with everything else in the world, so from your own perspective, especially through your books, what some of the kind of psychological tendencies you see behind people investing, and what are some of the biggest impacts on people's approach towards investing?
Yeah. So from a behavioral perspective, right? I'm a psychologist. My PhD is in psychology, not in finance. And so my work is all around sort of the psychology of how people make investment decisions. And so what I have seen is, first of all, there's like 200 different behavioral biases, right? There's effectively 200 different ways you can screw up your money. Like there's lots of ways that you can get it wrong. But one of the things that I did was I looked at that universe of 200 things, and I tried to narrow it down to sort of the most important, or the sort of meta biases, where one bias accounted for lots of different ways to make a mistake. And I found 4 primary things, and I'll give a quick overview and we can talk more if you'd like. The first is ego, right? So this is overconfidence. There's a couple of ways in which we're overconfident. We think we're luckier than other people. We think we're smarter and better than other people. And we think we know more about the future than other people. And I think you can see how all of these things can get you into trouble with investing, right? So it's like, okay, I'm going to put all my money in on this one sort of hot meme stock that everyone's talking about. Well, you know that you should diversify, right? You know that you shouldn't put all your eggs in one basket, but because you're overconfident, you go, yeah, but I did a little homework on this because I'm smarter than other people, and like, it'll be fine because I'm luckier than other people. And you may never say those things, out loud, right? You'd sound kind of annoying if you did, but we sort of all have these tracks running in our head. So you have to know about yourself that you're a little bit overconfident, if almost all of us are. The second thing is emotion, right? Emotion's just what it sounds like. It's letting your heart run away with your head. It's letting your gut kind of tell you what to do. There's so many times in life where emotion should be vibrant and rich, and it should lead the day. When you're dating, when you're getting married, when you're having a kid, these are emotional experiences. Investing should be unemotional. Investing is one of these things where you should be cool, calm, calculated. Like, emotion doesn't do anything but hurt you most of the time. The third thing is attention, which is our tendency to confuse things that are loud with things that are likely. Right. So if we look at the way that humans recall information, we're not very good judges of probability. Right. So we're sort of scared about the wrong things. Right. We're sort of scared about these low likelihood events that are very like in the news versus the high likelihood things that kind of are quietly corrosive. So I'll give you a few examples. Right. When we look at investing, Morningstar did a study a while back, big firm here based out of Boston. Morningstar did a study of mutual fund and ETF performance. And they found there was one thing that was incredibly predictive of how a mutual fund did, or an ETF, right? How a fund did. The number one predictor of how that fund did was how much it cost. Like the fee, not the ticker, but like the fee on the fund. So everyone is running around, right? Looking at valuations, looking at momentum, looking at, research, trying to figure out what the leadership's doing, and all this brain damage and struggle. All you have to do is buy cheap, well-diversified stuff, and you're going to beat most people. So we pay attention to the wrong stuff. We don't pay attention to the fees. We pay attention to all the higher profile stuff. And then the last one is conservatism, right? So conservatism is this tendency for us to confuse what we know with what's good, right? It's our tendency to be scared of the unknown. So if you look at every country in the world, right? If you look at every country in the world, I've been to Ireland 3 times. I've been to the UK lots of times. I lived in Canada for summer. If you look at a place like Canada, where I spent a summer, Canada represents 4% of the world economy, but the average Canadian has 80% of their stock exposure to Canadian stocks. Now, Americans, this isn't me being an ugly American. Americans do this too, but America's just a much bigger part of the pie, right? So Americans will put 80% of their money in American stocks, but American stocks are 55% of the global economy. So this is something we all do, right? We're Irish. So we say, you know what, I'm going to bet on these big Irish companies that I know. And like I pass their, I pass the building on my way to the bus stop, and that seems safe and familiar. Well, actually what you're doing is, sort of betting on, you're triple stacking your risk, right?
Mm-hmm.
You're Irish. If you're Irish and you live in Ireland, or, choose your country, your job is based on the economic prospects of Ireland, right? If you own a house or a condo in Ireland, your real estate is based on how Ireland's doing. And now your stocks are all based in Ireland too. Like that's a big bet on a single country. And so what people ought to do is spread their risk around, like own the world, right? Own a little piece of everything. But what people do, because of this conservatism bias, is that they load up and load up and load up on the stuff they know. And it's a form of sort of fear or lack of familiarity. So those are kind of the big four: ego, emotion, attention, conservatism.
I think they're awesome. Like straight out of the bat, like we could go into so much detail of all of them, but I think they just hit the nail on the head for everything that's happened over the last couple of, the last year or whatnot. And especially around conservatism, like people like that familiarity kind of aspect, and it has to be something that they know. And that kind of feeds into the ego as well, because it's like, which is confirmation bias. So it's like, okay, I know Tesla, I know Elon Musk, so it's just going to be all heavily concentrated in that area. So it's kind of like people build a thesis and then they just try to fill out that own thesis along the way. And that's really where you're neglecting other information, which kind of pulls into the attention option as well, because mainstream media will pull you down one avenue. And I know crypto's in a different world towards the traditional investing, but what's interesting is a lot of crypto momentum is driven by news. And they've done kind of like a couple of studies from this and whatnot. And you saw when it was going, it was pushing the 30K threshold recently enough, a lot of the news was driving it to there. And then you've seen momentum pick up that was going rapidly down, and vice versa then as it was rallying up to 60K. So I think that's an example of like extreme behaviors. But I think, yeah, it really hits a nail on the head on across the way, and I think a lot of the traditional investors would fall into those categories, and that's where they're kind of getting burnt.
Yeah, and I think it's important to know that these things never go away, right?
Mm-hmm.
Like I've found myself in the last year and a half, things have been so crazy. At least here, I can't speak for the Irish market, but at least here, things have been so crazy and so speculative. And me, like, right, I've written 3 books on what not to do with your money with respect to behavior, but I'm just as dumb as the next person when it comes right down to it. I'm just as emotional, I'm just as fearful, I'm just as greedy. So part of becoming a student of behavioral finance is, this isn't just a retail investor thing. This isn't just a new investor thing. This is a lifetime battle against yourself, right? To try and keep you from blowing yourself up and doing the wrong things.
How much does kind of greed come into this scenario? Just like we are at the moment, there's a massive kind of bull run in the S&P and all markets, like Dow Jones pushing its all-time high and whatnot continuously. How much is greed playing into this? Because as part of momentum, when it runs, people aren't taking profits and whatnot. It's continuously going. So is that one of the main kind of areas you see, as well as, and is there any other aspect?
Yeah, I think it's a couple of things. Greed is one. I'll talk about that in a minute. I think another thing that gets talked about less is loneliness, right? So we are coming off a profoundly lonely time. Even before this, Great Britain had appointed a minister of loneliness, because loneliness had been such an epidemic in Great Britain. Japan had appointed a minister of loneliness. And the physical impacts of loneliness and social isolation are dramatic. It's equivalent to smoking 15 cigarettes a day. It's twice as bad for your health as obesity. Like, we are wired as a human race to be together. And then what's happened for the last 18 months, depending on where you lived, we couldn't we couldn't be together, right? It was sort of forced isolation. And so I think the markets have become a way for people to sort of band together and to sort of express an opinion. And people were bored. Like, people were bored, people were lonely, people needed to make money because so many people had lost their jobs. Like, all of these things sort of contributed to this air of speculation that we're seeing right now. Greed is absolutely, like the driving force behind it. But I think the greed, like the greed match was lit and just thrown onto like just gasoline that was poured there through social isolation, fear, loneliness, necessity from people losing their jobs. So like COVID ended up being sort of like the perfect storm for speculation.
100%. And if you think about the stimulus checks, what came out, they had this excess supply. And then, people turned to Reddit. So as you said, with loneliness, Reddit is the ultimate storm for building a community and getting behind an agenda. It just takes off. They can put out an agenda and people get behind it, and it's just absolutely taken off over the last year. And I think that's the aspect of people turning to it, because people like to be part of a tribe, people like to be part of a community. And when you can find these little niches, and that's kind of what's happened in those small little kind of communities, people get behind them and then they run then from there.
Well, Reddit is the perfect example. You bring up the perfect example, because if you think about the message of Reddit, especially, I haven't followed it as closely lately, but you especially think about it in those early days of GameStop and AMC, and which I know are still kind of running. It was sort of this two-pronged message, right? It was, you're going to get rich, right? Like you can make a ton of money doing this, which is inherently appealing for all the reasons that we've talked about. And two, you're going to do it with a group of people like you, right? So like you said, people are inherently tribal. And three, you're going to stick it to evil, bad guys in the process, right? So like you're going to get rich with your buddies by sticking it to the hedge fund managers was the narrative. Right. Okay. Now we see that the hedge fund managers win in the end. Like Citadel and some of these different clearing companies were making millions off of this sort of the activity of all this retail activity. They're going to get their money, one way or another. But the narrative was absolutely, you're going to get rich, you're going to do it with your friends, and you're going to do it at the expense of fat cats who've been, sort of leeching off the economy. That was the narrative. And it's an incredibly compelling narrative when you're bored and lonely and stuck at home and there's a disease killing millions of people. It sounds like a pretty good time.
100%. Like, how do you factor in these elements into managing risk? So like to mitigate against these like psychological tendencies of people being, ego driven, looking for that attention, that confirmation bias, how, especially in your books, have mitigated against these big kind of risks, and what are the steps to take? Because, it's always the external influences that have a bigger impact than your plan and procedure. Like I have my own plan and process, but even if it's a Q4 plan, it's going to be difficult to live out. It's going to be a one hell of a Q4 as it is,
Yeah. Right. Yeah. So, I think there's a couple of things. The first thing I would say is know your why. Right. So I shared something on LinkedIn today. It was research that I cited in my book. I forget the name of the researchers, but what they found was a group of low-income people who were having trouble setting aside money. They barely were getting by. So they're telling these low-income folks like, hey, you need to save money. And they're like, well, yeah, easy for you to say, like, I have no extra money. Right. And so they try everything to get them to save money. And then finally they land on this thing where they show them a picture of their kids, right? So when they log into their bank account, a picture of their kids pops up for 5 seconds, and they have to look at a picture of their kid for 5 seconds before they can transact any business in the account. What this has the effect of doing is recentering them on why they're doing this, right? And what they found is that the people who looked at a picture of their kids for 5 seconds before making a financial decision saved more than twice as much as a control group. Okay. You may not have kids, your listeners may not have kids. That's fine. That's not the point. The point is recenter yourself on whatever that why is, right? Whether it's retirement in the tropics, whether that's, quitting work when you're 50, whether that's becoming the CEO of a Fortune 100 company, whatever, who knows, right? It could be myriad things. Whatever that looks like for you, keep that thing in front of you, because you've got to have a yes, like burning inside of you, that's bigger than the no of fear. Once you've gotten clear about your goals, I'd say you got to do 3 things, right? First thing you need is education. You got to figure out how markets work. You got to figure out how to invest. You got to get the basics, the meat and potatoes, the basic fundamentals of investing. You got to educate yourself. The second E is environment. You got to have the right environment, which is the right portfolio. Even the smartest investors in the world, the best, most patient investors in the world, can't endure some of the ups and downs of the most volatile assets, right? So you got to have a portfolio that is measured enough that you can take the ride. I give the example of this one fund in my book, The Laws of Wealth, talked about the best performing fund of the 2000s, right? Okay, so the 2000s sucked, awful performance, right? The US did negative numbers. If you bought in 2000 and you sold in 2010 and you held the whole time, you lost money, right? It's the only time in US history that's ever happened in a decade where you bought and held and lost money. It's called the lost decade. This fund, during this horrible time, this one concentrated stock fund, did 18.5% a year, right? So you would double your money a couple of times if you had bought and held over that time. And yet the average investor in that fund lost money, right? So how do you invest in the best fund of the decade and lose money? It's because people can't take the ride, right? Like it goes up, they hear about it, they buy in, it goes down a bit, they jump out, it goes back up, they jump back in. So
chasing the market.
Right. Yeah, chasing the market. So it's less important than you have a perfect portfolio, than you have a portfolio with which you can stick. So that's the environment piece. And then the third one is encouragement, right? You need someone in your corner. You need a coach. Maybe that's listening to your podcast every week, right? Maybe that's what people need to get kind of the reaffirmation that they're on the right path. Maybe what they need is a formal financial advisor, right? To help them hold their hand and talk them off the ledge when things are scary. Whatever that looks like, right? Whether it's a coach, whether it's an advisor, whether it's just a regimen of listening to good podcasts and reading good books, whatever it is, you need ongoing encouragement, because I promise you, over the 40, 50, 60 years that you're investing, your courage will flag, you'll doubt yourself, things will come into your life that you'll need support for. So get that education, get the right environment, get the right encouragement, then you're all set.
And I think what that leads into as well is consistency, because it's just time in the market versus timing the market, and that's a big thing, is when people are just trying to one, chasing the market, which we don't want, or else it's just being like inconsistent to keeping up with your strategy, and I think the more active you make it, the more inconsistent you're going to be. Like if you wanted to consistently trade all the time, the best thing maybe to have is a diversified pie that maybe every month on a monthly basis 5% or 10% of your salary is diversified that way, and then it becomes like automatic. And to your point at the very beginning when we started recording, make things automated, keep it stupid simple generally. And that's kind of always been my kind of approach. But I think, as you said there, like when the time changes in the market and the sexiness of it kind of fades out, like 2020, you would have seen maybe 35% return from March to December. And that's where all the headlines were. That's what the YouTube headlines are. But since then, we've seen obviously a bit of a pump, but it's not been the same, parabolic element to it. So how do you think about things like, consistency as well, so that people like that are 25 years old do consider this to be a longer term event, because it's kind of hard to keep it up if you don't have the right people in your corner.
Yeah, there's two things that are so great about consistency. The first is that what you do consistently becomes habitual, right? It's muscle memory. It becomes
Mm-hmm.
easier and easier to do. So that decision you made to save the first time was quite wrenching. It's quite difficult. The 50th time, it's a no-brainer, right? You don't even think about it. But what's even better than that to engender this kind of consistency is just to automate things, because any way you can take a behavioral bias and make it work for you is a good thing. You know, I talked earlier about how kind of lazy we are, how conservative, how status quo prone we are. The same laziness and status quo proneness that can work against you can work for you if you just automate it and you let it run. Because look, we're lazy. We're unlikely to touch it. If we've locked in a good behavior, we're likely to let it run and be consistent. So, I think that's one of the most powerful things that you can do.
Is that rule-based approach kind of looking at ETFs, you think, instead of kind of picking stocks? Like, what's your kind of approach? Like a global basket, also looking at different elements of, Asia, APAC. It could be also European based.
Yeah. So Nassim Taleb has a great quote that I'll screw up here, but he basically says, never ask a man his opinion, ask him to see his portfolio. So I'll tell you what I do, right? So rather than kind of giving you my opinion, I'll show you what I do with my own money.
Awesome.
95% of my money is in cheap, diversified index funds. Okay. 95% of my money, half in the US, half abroad, Europe, Asia, everywhere. Right. And that just every month, a good chunk of my paycheck just goes into buying more and more diversified portfolios. 5% of my money is absolutely mad, right? I have a tendency, right? I have a tendency to do all the stupid things we've talked about today. And I know that about myself, right? I want to day trade. Like, I want to follow hot stocks. I want to take a bet on AMC or GameStop or, whatever is in the news. And that's fine. I know it's stupid. I know that net, it's probably not going to be as good for me as if I had taken that money and allocated it to the other 95%. But what it is I sin a little to keep from sinning a lot, right? I know this about myself. I know I have these bad tendencies. And so I'm going to give myself a little bit of flexibility to sin, if you will, so I don't sin with my, quote unquote, real money. So I keep a little aside, 3 to 5% to just be crazy with. And if you want to buy, hot stocks, if you want to buy heavily beaten down stocks, you want to do whatever, I sort of have permission to do that with that 3 to 5% because I'm so sensible with the rest.